What can you say about cash as your investment? Mr. Raymond Dalio shared the most people think that cash is safe. Cash is the least safe investment and it just doesn't have the same volatility to it. In 1945, we began a new world order. 1944, we created a new monetary system. We call it the Bretton Woods monetary system. We started that new world order and that has created a bull market in stocks, an American world order for the most part. There's a cycle that we're used to in which whenever you have an economic downturn, the central bank hits the gas and can create that expansion that later produces an increase in demand. That happens in three phases in the cycle. Normally, it's interest rates. When you lower interest rates and the economy turns up. But when you hit zero interest rates, which happened in the debt crisis of 1932, we then hit zero interest rates. Then you go to the second type of monetary policy, in which central banks print money and buy financial assets to add liquidity in those purchases. Seller of bonds who get the cash to go out and buy other financial assets. And we have the process going through. The only two times that happened were 2008 to 2009 and 1929 to 1932 zero interest rates print funding monetization. There's what he calls monetary policy 3. Which means that money does not trickle down to the population and go to all the places that it's needed to go. So in other words, the coordination between fiscal and monetary policy so that the central bank is buying a wide range of assets of a different producing liquidity and also having the effect of purchasing government debt and monetizing it. That's the late cycle of an expansion. That's what's driving the markets and economy now. For an instance today, the Federal Reserve and the government is creating the liquidity that we see in the markets. It has significant implications for the value of money. What is the value of money? Where does the money go? Cash is going to be a poor investment as well as the character of the environment, which means that if you look at the return assets of classes, you take cash. Isn't it an exciting world when you have zero or negative interest rates? Also, then there's the desire to create a spread so that short-term rates are lower than long-term rates. And there is so much liquidity. It is the central bank that is making that market. So when we look at the market today, it needs the storehold of wealth, and we can see that it is reflected in all asset classes. So that's the main driver, and it also has massive geopolitical implications because as we come into the environment where we have the second, which includes the wealth gap and the political gap, it means that the distinction of how money and the bills are going to be divided. In relation to that, we should look at how that will affect tax policy because it will matter a lot. Mr. Dalio thinks it's very much like the 1930s, which means it doesn't produce immediately a general level of inflation. It negates deflationary pressures, and the effect of that is it makes currency depreciation over some time. In the 1930s, all currencies depreciated in relationship to gold, particularly at that time, and here's what we see. It is the same kind of thing happening without a general level of inflation. But not just gold. It goes into other storeholds of wealth and stock, particularly certain types of stocks, to very much the same as in 1933. In March of 1933, Franklin Roosevelt severed the connection with gold, printed money, and made money available, and that was the exact bottom of the stock market. That is very similar to April 9th when Federal Reserve and the Treasury did the same thing. So that goes into other assets such as stocks, and then it creates reflation. It is necessary to be gone because the consequences of not doing it are unacceptable. The wealth gap and the political gap. We are in a situation where every individual, every company, and every government has a certain amount of revenue, a certain amount of expenses, and a certain balance sheet. When the revenue goes down to below or inadequate relative to the costs and there is not an adequate balance sheet, then defaults and restructurings take place. That's also true for the population as a whole, and that's true for several businesses and the policies that he is saying. What has been true throughout history is when you have an economic downturn, a severe economic downturn, and less effective monetary policies at that same time, and you have a large wealth and values gap and political gaps, you tend to have fought. Internal conflict can happen. If there is a rising internal conflict, that can divide the wealth pie, and in our history has become normal. That's the dynamic he thinks that they are now observing that will become manifest in changes in tax policy. The investment environment going forward will be very different from the background of the past. Think about it as zero and low. very low returning asset environment because the liquidity that's in the market is driving the excess returns of all the markets down to be lacking in relation to the meager cash rate. That is why negative real returns are not good for cash. The most important thing is to know how to diversify well. What Mr. Dalio is trying to say is to go beyond just the traditional 60-40 stock bond mix or even the same countries and to broaden that diversification. You need to include in that portfolio some assets that might seem unusual. You need to have, for example, some gold, and you can include inflation index bonds. You must think about the currency exposure. When you think about safety, you think differently. Most people believe that cash is safe to cash. It is actually the least safe investment. It just doesn't have the same volatility to it because they're producing so much cash. It has a negative real return. It is a tax that may be 8% a year. You lose some money in terms of cash. So Mr. Dalio is encouraging you to think about risk differently. You must have to diversify it, and the best thing that you must have is a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things he mentioned are tax policies and geopolitics. Certainly, we all have to experience it. This pandemic can cause us to think, for example, how will the next wave will come back? Here, we can plan how we apply diversification and hope it can be achieved without reducing the expected returns because of the way that passive classes are priced. Then, if you're going to take tactical bets from those that tactical bets, alpha on top of that strategic well-diversified portfolio should have highly diversified bets deviated. Liquidity is going to be more important than before because things change in unexpected ways. We can look at how in many cases, the businesses that one could have thought was a good business was not. And for example, if you're in private equity and you're with that company, you have to think about restructuring. The ability to rebalance and diversify and be cautious about making a highly diversified set of bets for the future while thinking even about asset classes. You need to think about the value of money. As we look at asset classes, you may want your money to be in stocks. You will look for which stocks are you going to put your money with. But most people don't think about stocks and bonds. Most of them think about those traditional asset classes. But people sometimes don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify as well. He believes those are the things that have to be paid attention to in much as they were important things in years before 1945. But the interesting thing about that is when you look at when interest rates we call, bonds approaches zero expected return. Clearly, their ability to go up in value or interest rates to go down in value is limited. And to have the impact, one has to leverage those a lot, and that's not desirable. But clearly, going through history, as he studied the last 500 years of cycles, as we go back to the Dutch cycle in terms of the Bank of Amsterdam and the whole cycle, says that all cases in central banks will print money and devalue money when they get in that course. The basic problem of depression is that liquidity problem. So always through history, the choice will be reflation even when you hit interest rates in the way that we are looking at it now. For us to understand the nature of the diversifying asset and how it has shifted in terms of other assets in that particular time will benefit from reflation, because it will either be reflated or just die. We can always see reflation, and that's why in history, we can see that all currencies have devalued or died over a period of time, particularly in such periods. We are now in a new paradigm, a new way of thinking or doing things that replaces the old way. We have to make decisions that will help us to see the greater benefit. History is always repeating itself, and all we have to do is to learn from lessons from the past and see how it can help us think well about how we manage our money nowadays.